This LOS is described credit risk and credit-related risks affecting corporate bonds. Okay, before we jump into this LOS, we'll do a little bit of an introduction to the reading. So with bonds outstanding worth many trillions of US dollars, the debt markets play a critical role in the global economy. Companies and governments raise capital in the debt market to fund current operations, buy equipment, build factories, roads, bridges, airports, hospitals, acquire assets, and so on. By channeling savings into productive investments, the debt markets facilitate economic growth. Credit analysis has a crucial function in the debt capital markets, efficiently allocating capital by properly assessing credit risk, pricing it accordingly, and repricing it as risks change. How do fixed income investors determine the riskiness of that debt, and how do they decide what they need to earn as compensation for that risk? So this reading and the LOSs that we're going to look at in the next few sections, it covers the basic principles of credit analysis, which may be broadly defined as the process by which credit risk is evaluated. Readers will be introduced to the definition of credit risk, the interpretation of credit ratings, the 4 C's of traditional credit analysis, and key financial measures and ratios used in credit analysis. This reading, among other things, explains how to compare bond issuer creditworthiness within a given industry as well as across industries, and how credit risk is priced in the bond market. Credit risk. Credit risk is the risk of loss resulting from the borrower, issuer of debt, failing to make full and timely payments of interest and/or principal. Credit risk has 2 components. One, the first is known as default risk or default probability, which is the probability that a borrower defaults. That is, fails to meet its obligation to make full and timely payments of principal and interest according to the terms of the debt security. The second component is loss severity, also known as loss given default in the event of default. That is, the portion of the bond's value, including unpaid interest, an investor loses. So again, credit risk is the risk of losses if borrower fails to pay interest or principal. 1, we have got the default risk, which is the probability of default. 2 is the loss severity, the amount or percentage of principal and interest lost if the borrower defaults. So here we have a little calculation. The expected loss equals the default risk times the loss severity, and the recovery rate equals 1 minus the loss severity in percentages. So important credit-related risks include the following. 1 is spread risk, which corporate bonds and other credit-risky debt instruments typically trade at a yield premium or spread to bonds that have been considered default risk-free, such as U.S. Treasury bonds. Also, there's credit migration risk or downgrade risk. This is the risk that a bond issuer's creditworthiness deteriorates or migrates lower, leading investors to believe the risk of default is higher and thus causing the yield spreads on the issuer bonds to widen and the price of its bonds to fall. Market liquidity risk. This is the risk that the price at which investors can actually transact, buying or selling, may differ from the price indicated in the market. To compensate investors for the risk that there may not be sufficient market liquidity for them to buy or sell bonds in the quantity that they desire, the spread or yield premium on corporate bonds includes a market liquidity component in addition to a credit risk component. A quick practice question to check our understanding. For an A-rated corporate bond that has deteriorating fundamentals but is expected to remain investment grade, the greatest risk is most likely A, default risk, B, liquidity risk, or C, credit spread risk. Okay, the correct answer is C. Credit spread risk is correct since the bond is expected to see a widening of spreads as a result of deteriorating fundamentals and a potential downgrade, but still remaining investment grade. Another quick practice question. When are credit spreads most likely to narrow? During A, economic expansions, B, economic contractions, or C, a period of flight to quality? I think this question is pretty easy. Be happy to see that on a CFA exam. Anyhow, A is correct. Credit spreads narrow during economic expansions and widen during economic contractions. During an economic expansion, corporate revenues and cash flows rise, making it easier for corporations to service their debt, and investors purchase corporates instead of treasuries, thus causing spreads to narrow. Another quick practice question. What type of risk does the bid-ask spread most closely measure? A, default risk, B, inflation risk, or C, liquidity risk? Again, I think that question should be fairly easy because whether we're talking about stocks or bonds, C is correct. The bid-ask spread is a function of liquidity. So C is correct because the size of the spread between the bid price and the ask price is the primary measure of liquidity of the issue. Liquidity risk is the risk that the investor will have to sell a bond below its indicated value. The wider the bid-ask spread, the greater the liquidity risk. And two more quick practice questions to finish this LOS. The first one, which of the following best defines credit risk? A, the probability of default times the severity of loss given default. B, the loss of principal and interest payments in the event of bankruptcy. Or C, the risk of not receiving full interest and principal payments on a timely basis. Okay, C is correct. Credit risk is the risk that the borrower will not make full and timely payments. Again, I just wanted to jump into the glossary quickly to show you the importance of, you can copy and paste and print out the glossary as a Word document if you're using the ebook, but it's really important just to go through the glossary and pick up on all these terms because a lot of the questions are just based on definitions, as that last question was. So you can see here I've highlighted credit risk is the risk of loss caused by a counterparty's or debtor's failure to make a promised payment, and it's also called the default risk. So if I just scroll up a little bit here, you can see that there is a lot of definitions with regards to credit. The first one, credit. With respect to double entry accounting, well, that's talking about the debits and credits. Credit analysis, credit curve, credit default swaps, credit derivatives, credit enhancements, credit-linked coupon bond, credit-linked note, credit-linked note, credit migration risk, the credit scoring model, the credit spread option, credit tranching, credit worthiness. So you can see getting up to speed on all these terms as you go through the reading on fixed income is really important. A lot of times the questions are just based straight out on definitions, okay? So later on we'll be getting into credit tranching and credit worthiness, etc. And this is a nice practice question to finish on. It's not a definition, but a measurement. If you can't measure it, you can't manage it. So which of the following is the best measure of credit risk? A, the expected loss, B, the severity of loss, or C, the probability of default? So A is correct. The best measure of credit risk is the expected loss. The expected loss captures both of the key components of credit risk, the product of the probability of default and the loss severity in the event of default. Neither component alone fully reflects the risk. And that's the last slide for this LOS. Thank you.